Hello, my name is Simon Nicholson and today I'm going to talk to you about FLR Corporation, which has the NZSE ticker FLR. FLR Corporation is a holding company that through its subsidiaries provides engineering, procurement and construction management and project management services. FLR serves a number of industries worldwide, including oil and gas, chemical and petrochemicals, transportation, mining and metals, power, life sciences and manufacturing. FLR is also a primary service provider to the United States federal government. The company is aligned into 5 principal operating segments: oil and gas, industrial and infrastructure, government and global services and power. FLR's roots extends back to the 20th century when a family of Swiss immigrants set up a construction business in the western United States. Over time the business evolved, first in 1912 as FLR Construction Company, then as FLR Corporation, by which it is known today. Over the decades, FLR has expanded its expertise across industries and around the world. Today, it is active in more than 25 industries on 6 continents. From the Buddha Tower in the 1920s to the Trans-Alaskan pipelines in the 1970s to the largest polysilicon facility in 2008. Now let's look at the financial statement analysis of FLR Corporation. This has been divided into 4 areas: liquidity, activity, leverage and profitability. The liquidity looks at the riskiness of the firm's security. Activity, how quickly a firm converts non-cash assets into cash. Leverage is the ability to pay long-term debt, and profitability looks at the firm's use of assets and control of expenses to generate acceptable returns. With liquidity, we've looked at the current ratio. All of these ratios are over 3 years of 2007, 2008 and 2009. Current ratio is the ability to pay off its current liabilities, and this has shown a favourable trend of 1.42 in 2007, increasing to 1.55 in 2008. And this is also in line with the net working capital, which has shown to follow trend, a similar trend. Next, the return on equity. Return on equity starts at 23.45% in 2007 and shows an increase to just under 27% in 2008 and then a decrease in 2009. So the net income per shareholders' equity having a decrease in 2009 is as would be expected with the financial crisis that we've been experiencing. The inventory turnover, which is how many times the inventory is sold and replaced over the year, has also shown a slowdown after a favourable increase in 2008. We saw a slowdown in 2009. The debt-equity ratio, or how aggressive the company has been in financing its growth with debt, has shown a decrease from 1.55 in 2007 to 1.08 in 2009. This also shows with the debt ratio, which we require to be below 1 so that the total debt is not in excess of its total assets. Down to 0.74 in 2009 holds the company in a good position to weather some of these financial storms. The net profit margin, which is how much profit for every $1 of sales, showed a nice increase in 2007 to 2008 above industry averages, but then a decrease in 2009. And this trend also follows with the earnings per share. Earnings per share is important, or is an important determiner in determining share price growth. So we can see or expect in 2009 a decrease in share price, which we have seen. In order to gain a better understanding of this financial analysis, we need to compare these results now to the industry. Now we can see that FLR is better than the industry average across most of the ratios we've just looked at, apart from profit margin. We can see the earnings per share in the trailing 12 months at $3.83 is above the industry average of $2.02. Profit margin is below at 2.87%, below the industry average of 3.7. However, its dividend yield and payout ratio considerably in excess of the industry average, as is its annual dividend at 50 cents per year. However, we did see a few years ago the annual dividend reaching 80 cents per share. Current ratio is on par with the industry average at 1.55, and the return on equity is greater at 0.21 compared to 0.01. Inventory turnover is also low at 14.72 times compared to 33 times on the industry average. On looking at the financial analysis, we can see that FLR is in a strong position. What are its other strengths? It's showing strong performance throughout the economic downturn. It has advantages of scale and experience that few other construction firms can match. It has a very strong balance sheet. The company at present has 70% of market capitalisation in cash while carrying no debt. Has a diversified portfolio with multiple growth areas, which include mining, infrastructure, government. The oil and gas is in transition, but there's a lot of upstream growth as expected. Has considerable financial strength, ample cash and liquidity, and it is focused on growing the business. The threats that FLR experiences, the company is involved in a very cyclical industry. The extent of the global recession, as everyone knows, is unknown, and some projects are on hold or have been cancelled outright, such as a $1.2 billion project recently cancelled in Russia. There is also a lot of uncertainty over the price of oil and therefore the true value of this industry. The tightening credit markets could serve to create fewer customers in the industry. So in summary, FLR serves a broad and diverse group of markets globally. Its prospects in mining continue to show particular strength, while operations and maintenance spending remain weak. FLR's oil and gas markets are still in transition, but there are indications that a number of key projects could be released this year. Also, as discussed, the value of these oil projects is uncertain. Overall, FLR's new award prospects across its portfolio are substantial. The marketplace for engineering and construction services is increasingly competitive, which will likely impact the company's overall profit margin, especially when considering the growth in mining projects, which typically carry lower than average margins. FLR say that they are encouraged by the potential for increasing bookings in the coming quarters and have reaffirmed their 2010 earnings per share guidance range of 2.8 to 3.2 or $3.20 per diluted share. So thank you, that's my presentation on FLR Corporation.